Tonight, I want to cover a wide variety of markets in this update because there's some interesting things going on across the stock market. The first thing to note is that US markets are still solidly in stage 2. The S&P 500 has almost 65% of stocks in stage 2, and the Russell 2000 actually transitioned into stage 2 as of this week. Even the foreign markets that have been lagging the US markets, we can see that almost 70% of developed foreign markets are in stage 1 now, and almost 40% of emerging markets are in stage 1. When you combine that percentage with the number that are in stage 2, you can see that even foreign and emerging markets, for the most part, are in a advancing or in a basing phase, and with only like 6% of foreign markets still in a stage 4 decline. And similarly, only 20% of S&P 500 stocks are in stage 4. So there's few stocks to choose from for the bears, but there's still a lot of bears out there overall in the markets. Now, looking at the Russell 2000, we can see that it did break into stage 2 this week, and it's starting to potentially outperform the S&P 500, and that's important because typically in bull markets you see small cap stocks outperform larger cap stocks. Now, one of the things that the bears are still kind of holding their hats on is the stage 4 decline in foreign stocks in a lot of different foreign markets, but as I showed on the screener, we're now kind of in a stage 1 basing phase in foreign stocks, and this index is basically a world index without the United States. So you can see that this index has been declining since the middle of 2014. So this bear market is about 2 years old now, which is typical for bear markets, and it's been underperforming the S&P 500 ever since the start of 2013. So if we can see foreign stocks continue to base here and then break out into a stage 2, that'd be very bullish for the equity markets all over the world. Now, one thing that is interesting about the Ameritrade Investor Movement Index is this index actually tracks what Ameritrade customers are doing in their actual portfolios, and they've essentially been selling more stocks than buying ever since the late 2013. So they've been getting gradually more bearish for multiple years now, even though the equity markets, the S&P 500, has essentially gone sideways all during this time. And what's really happening here is people are getting worn out by this sideways grind in the S&P 500 and progressively getting more bearish. And we've seen a lot of major stocks get obliterated during this time period as well, which has probably contributed to the overall negativity and the selling that's going on in a lot of these portfolios, because once they have big losers combined with other stocks that have held their ground, they end up, eventually shedding positions to, avoid losses, even though that the overall market's kind of treaded sideways during this period. So this is something typically, bear markets can either move through time sideways, or they can move through price, and either way they typically make sentiment a lot worse by the time they're over, so that gives the market the ability to enter a new bullish phase. Now, looking at some of the sectors that are actually outperforming the S&P 500, the semiconductor sector is actually almost ready to make a new all-time high in the XSD ETF. And notably, this ETF didn't make a lower low in early 2016, unlike the S&P 500, where it made a lower low, lower than the August crash. So you can see down here that this ETF has been outperforming the S&P 500 for a few years now, and it's potentially going to break out of this kind of consolidation here and continue to outperform the S&P 500. And looking at a couple stocks in this sector, Nvidia in particular is really one of the big market leaders right now. And you can see how stocks that typically buck the trend in the overall market when it's in a bearish phase typically become new leaders once the pressure from the overall market is lifted. For example, when the S&P 500 crashed in August, this stock actually held its ground extremely well. It actually gapped up on high volume above the 30-week moving average. And once the pressure from the S&P 500 was lifted, we got multiple high volume weeks, which led to a huge rally in Nvidia. And then when the S&P 500 crashed again in early 2016, this stock went down with it. But once that crash was over, again you see high volume coming back in, and big buyers coming back in to buy the stock, and it pushed it back up again above the 30-week moving average on big volume. And ever since then, this stock has been on a tear. So this is a prime example of how a stock that holds up well during a bearish phase in the market can really become an outperformer. And notice that from a stage analysis perspective, this is not a good time to buy Nvidia, obviously, because it's stretched above the 30-week moving average. And the best times to buy are when the stock retests and then breaks out back above the moving average, confirming that the uptrend is still in place. Now here's Advanced Micro Devices, and this stock had been underperforming the S&P 500 up until the last few months, where you've seen some bullish action and some high volume increases on the stock, and it really broke out above the 30-week back in February, and then retested and broke out on massive volume last month. And actually, for disclosure, I'm long the stock, so this is another example of a stock that's in a leading market sector. Now, another sector that's actually leading the markets right now is the U.S. medical devices sector. The IHI ETF broke out back in March to a new all-time high, and it's been going up ever since. Notice that the volume on this ETF has been above average for multiple weeks throughout this year as it's broken out to a new all-time high. And here's a stock in this ETF, Medtronic. Notice how this stock followed the S&P 500 lower when it crashed in August, but during the pullback in January this year, notice that the stock took very little damage at all, which again is a sign that this stock is ready to become a leading stock once the pressure from the overall market is lifted. And this stock broke out once again back in April and is establishing new highs. As well, it's been outperforming the S&P 500 for multiple years now. Now turning to gold, I find that gold is in a pretty interesting place right now because it's retesting the 30-week moving average as we speak, and notice how that it's gone sideways ever since February still. So we're talking about essentially a 4-month consolidation now as we're entering June. And the retest of the 30-week moving average is really the second ideal buy point for a new bull market. So from a stage analysis perspective, gold is actually in a really good spot right now for the bulls. And we're going to be able to tell over the next month or two whether this bull market is for real, if gold can hold its ground here and then start establishing new highs once again. Now, the gold stocks are still a little ways above the 30-week moving average, but they're a lot closer to it than they were just merely a month ago. And really, these stocks, gold and the gold stocks, suffered a pretty bad May where they pulled back pretty much the entire month. but the GDX ETF is only about 15% above its 30-week moving average now. And again, the pullback was on lighter volume than the breakout. So we're going to see once again with GDX whether this stock can hold above the 30-week and then bounce and move higher, which would confirm the bull market in gold stocks. Now, just to show an example of this silver mining stock, GPL, was just in a parabolic moonshot at the end of April. And up here, it was essentially about like 150 to 200% above its 30-week moving average. But now it's only about 30% above its 30-week moving average. So we can see that over a period of 4 weeks on this big pullback, where it pulled back like 30 to 40%, but it's already much closer to a better buy point than it was, merely a month ago. So once again, when these stocks get so extended like this, it's better to wait for a buy point if you're looking to get back in versus chasing things that are super extended, because all in all, what I kind of expect the gold stocks to kind of trade sideways for a few months now towards the end of the summer, and then probably the real breakout will commence after that. But you can see gold stocks have a pretty good bounce here, considering that the GLD is retesting the 30-week as we speak. And one other stock I just wanted to highlight really quick is a stock that I got into recently, which is CLF, Cliffs Natural Resources. And notice how this is another good case of a nice solid stage 2 breakout, where we have a stage 4 decline and then really kind of a basing phase that you could consider it, maybe it started back in the middle of last year, so it's been going on for about a year now. And then we got a big massive increase in volume once it started penetrating the 30-week moving average back in March, and then a big blast off above it back in April. Pretty sizable pullback back last month in May, but this week, especially yesterday, Cliffs busted out above the 30-week again on massive volume, and the volume this week is going to be even higher than the 90 million share week it did back in April. So, this is an example of a stage 2 breakout, a retest, and then another powerful breakout as we speak this week, which is really textbook stage analysis as far as how a stock typically transitions from a bear market to a basing phase and then to a new bull market. So overall, as I said in the beginning, the U.S. markets are configured bullishly still. Of course, things could change at any moment, and if the indexes do dive back below the 30-week moving average, they will go back into bear markets. But until that happens, you got to look at the trend as your friend, and none of the short index ETFs are in bull markets right now, so that's not where you want to be if you're following stage analysis. So this is a sector page that I follow, just look at the bear side. But until these things move back into stage 2, there's no point in being bearish, because the trend is not to the downside. So that's a good thing to monitor if you're trying to monitor, when we would transition back into a bear market. But that's just not happening quite yet.